This is where most traders make the mistake. They see this big bearish move and immediately think, I'm going to wait for a pullback and short it. They might mark this area out as a good zone of interest and expect price to do this. But watch what actually happens. It runs straight through the area they wanted to sell from. It never goes lower from this. So why did this happen? Because this wasn't the start of a big bearish trend. It was a pullback inside of a bullish trend. Today I'm going to show you how to tell the difference between a pullback and an actual trend reversal, and where Fibonacci fits into all of this. If you watched the previous lesson, we talked about how important the major break of structure is. Once price gives us that major break of structure, which is here, our job is no longer to fight the trend. So once you see the major break of structure, the higher low is confirmed. And this is when we pay attention to the counter trend, which is right here. It creates a high and a low, a higher high and a higher low, a high that is higher than this, so this is a higher high and a higher low, another high and a higher low, a new higher high, and this is where we see the break of the counter trend. So once the counter trend turns bearish, that is when the higher high is confirmed. So this is the low of the range and this is the high of the range. When the counter trend turns bearish, that is when the high of the range is confirmed. This is where we use the Fibonacci. We draw it from this low to this high. Anything below 50% is considered discount. Now, as the saying goes, buy low and sell high. So instead of buying at expensive prices, we patiently wait for price to move into discount. The 61.8 and the 70.2 levels are also key areas of interest. And these are areas where you'll often see pullbacks coming to an end. Once price reaches one of these areas, we don't buy it immediately. We wait for the counter trend to once again turn bullish. Now, if we look at the counter trend, it's right here. And once this counter trend turns bullish, that is when we start looking for long opportunities once again. You can even drop 1 or 2 time frames lower and wait for structure to break back in the direction of the major trend. Now let's drop down to the M15 maybe. So if you look at the counter trend on the M15 time frame, you can see that you had a high here, a lower high, and a lower low, a new lower high, and a new lower low, and then we got the break of structure right here. So now you know that the counter trend has also turned bullish at a discount price. So once you get this break of structure, you can once again draw your Fibonacci from this low to this high. And you can place your entries at around the 61.8 or the 70.2 levels. Now we're not going to talk about entries today, so just pay attention to how the market pulls back before expanding. Pulls back before expanding. That is what the market does. So it pulls back down and expands again. So you have a new break of structure right here. So like I said earlier, once you see the break of structure, the break of this high, the low is confirmed. The high low is confirmed. Once you see it breaking the counter trend, which is here, that is when the high is confirmed. And that is when you draw your Fibonacci from this low to this high. And you expect it to move into discount. So you do the same thing again. You have a low here. Once price breaks through this, the low is confirmed. And when price breaks through the counter trend, now follow this counter trend. It creates a high and a low, a higher high and a higher low, a new higher high and a new higher low, a high and a breakout. So when price breaks through this low right here, that is the confirmation that you have a new higher high. So you draw it from the previous low to the new high. And when it moves back down into these 61.8 and 70.2 areas, that is when you look for a long position. So let's assume you drew the Fibonacci from this low to this high. And this is where you place your entry at 61.8. Your stop loss can go below the previous high low because we know that in an uptrend, the lows are protected and the highs are broken. You pay yourself and you can even leave the rest into the higher time frame higher high because we expect this high to break on the higher time frames. So what actually happens? There it goes. It goes up and it breaks through the high. Now remember, this is hindsight. We can clearly see the completed move because the story has already finished. In real time, we don't have the completed chart yet. That's why trading is a game of probabilities. We use market structure to build the highest probability idea, wait for confirmation, manage our risk, and let the market prove us right or wrong. Now that's a very clean example, but not every pullback looks like that. Let me show you another one. We have a high here that broke through this low. So this would be the new lower high. And when price starts pulling back, this would be the new lower low. So we once again draw our Fibonacci from the lower high to the lower low. And when price starts moving into a premium area, we drop down to a lower time frame and wait for the minor trend to turn bearish again. So let's see what happens. Now, these are the types of candles that confuses many of us. But keep in mind that a strong candle will not change direction. Only a break of structure can change direction. So when price is in a premium area, we can drop down to a lower time frame and wait for that lower time frame minor trend or the counter trend to turn bearish once again. So let's see what happens. And here we have that. We have a low, a higher high, and a higher low. Price created a new higher high, and we can see a break of structure right here. So this is a sign that sellers are entering this market again at a premium price. So we can go to a lower time frame, and now we can start looking for an entry. And when price starts pulling back, again, we draw our Fibonacci from this lower high to this lower low, and we place our entry at around the 61.8 or the 70.2 levels with our stop loss above the previous lower high, and we can target down here. So let's see what happens. Yeah, and this is a losing trade. Now, even though we had all confirmations that the market wanted to move down, it can still do this. But remember that just because we lost this trade, it doesn't mean our analysis is wrong, or it doesn't mean that the direction has changed. So we can still accept this losing trade and wait for another opportunity because this is normal. This happens. Nobody can predict the market correctly 100% of the time. So we patiently wait. We go back to the 1 hour. We draw our Fibonacci from the high to the low, and we wait for the same exact thing that we waited for in here. So let's see if the lower time frames are turning bearish once again. Let's patiently wait. And look at this. It tapped exactly into the 61.8 level, and if you follow this little minor trend, you can see how price broke that to the downside. So now this minor trend is in line with the major trend. Or else for a better confirmation, we can even wait for price to break through this low here. Because that way we have a clear bearish breakout. We had a high, a low, a high high, and now we have a break of structure very clearly. So now this is a confirmation that the bears have entered the market again. So you draw your Fibonacci from the new high to the new low, like this, and you place your entry at the 61.8 level. Stop loss can go above this, and you expect a new lower high to form somewhere here. And since this is a downtrend, you expect the highs to be protected while the lows to break. So you place your stop loss above this high and your target would be down here. Now let's see what happens in this example. There it goes. It taps into the 61.8 level and then it starts moving down like that. So if you got this trade, you can now move to break even, or you can place your stop loss above the new lower high. We'll talk about all those later. And if this wants to continue moving lower, you can start leaving some runners like this. Now let's see what happens. And there it is. Now it starts moving lower. So now you have a new high and a new low, a new lower high, and our price is still moving down. So this is our new breakout structure, which means we have a new lower high. And when price starts moving up, we draw our Fibonacci again. The reason I don't draw the Fibonacci at every swing point is because of this. Now, what most traders do is, as soon as they find a new swing low, they draw their Fibonacci from the recent swing high to the recent swing low and expect price to move into premium. But you can see how it reaches nowhere near premium. And once again, when a swing low forms, they have to keep redrawing it. So the best thing to do is wait for the minor trend that is moving lower here to turn bullish again. So that way you know that an actual pullback has started. So look at this. When this little minor trend here turns bullish, you draw the Fibonacci from the previous lower high to the previous lower low. And pullbacks like these, it does two things. One, it pushes price into a premium level. And then the next thing is that this confuses a lot of traders. Now most traders would mark out zones from somewhere here and they'll be looking for long trades from this area here with their stop loss below this because they think that buyers have entered the market. But the context is different here. The higher time frame breakout structure was bearish. Price moved into premium and it is turning bearish again. So when price goes into a premium level of this range, we don't look for long opportunities anymore. We start looking for sell opportunities. So let's see what happens. Price then moves up. Now it is creating a minor trend that is bullish. And when that minor trend turns bearish, we have a high, we have a low, a new high. And when price breaks through this low here, we have a confirmation that the market wants to move down because it went into a premium price and then it has turned bearish. So when it starts pulling back up, we draw our Fibonacci from this high to this low once again, and we sell at the 61.8 level or the 70.2. I prefer 61.8. Stop loss can go above this high or even slightly higher. And then you can even target all the way down here. But you have to pay yourself when price breaks through the previous lower low. So you have this and this high, a lower low here. And if price comes back down into this, this is where you pay yourself. So let's see what happens. And there it is, starting to move down. So you can even leave the rest down into this low. So let's see what happens. So again, when price starts bouncing off of these levels, people jump into long opportunities. They try and buy it here. But we know that the context is not there for a buy trade. So we patiently wait for the market to turn bearish again and we start looking for bearish opportunities. So it moves up once again into our entry and then it starts moving down. So you can see how buying did not really work here. That is because the market structure is still bearish. The highs were protected while the lows were broken most of the time. Now if you go to a higher time frame, you had a lower high, a lower low, price then created a new lower high, and now it created a new lower low. So the best place to take the trade from is above the 50% area or at a premium price, because if you're selling it, you have to sell it at a higher price. So anything above 50% is a good area for us to sell from. And now you might be thinking we sold it below 50%, but if you draw the Fibonacci from this high to this low, we did sell it at a premium price again. So that was another example with a little complex pullback. Let's take a look at one final example. In the previous video, we talked about the price action here and how this was the most recent major break of structure. So this is probably a pullback into a discount price of this range from this low to this high. But we're not going to just sit and wish for price to move down into a discount area. Instead, what we can do is trade this pullback using a lower time frame, because it may take weeks or it may take months until price reaches here. We don't know. So now let's take a look at this price section on the 4-hour time frame. We have a high here. We had this low. Price then pulled back into a premium price of this range from this high to this low. It moved into a premium area, moved back down, and then it broke structure right here. So this break of structure confirms that this is the new lower high. And when price breaks through this, we know that we have a new lower low, which is down here. So this break of structure here is not going to change the trend. Now, even though you can see a clear breakout, now we have a low, a lower high, and a lower low, then price broke through it. Even though we have a bullish breakout here, this break of structure is not going to change the trend, because this is the most recent major lower high. These are just minor highs that are inside of this overall range. So in order for a price to break structure to the upside, it has to run above this high here. It's not this high. So we are still bearish until it moves above this. So we do the same thing again. We draw the Fibonacci from this lower high to this lower low. And when price reaches premium, we can move down to a lower time frame and wait for that lower time frame minor trend to turn bearish once again. So let's see what price does. It moves up. Let's follow this little minor trend. We had a high, we had a higher low, we had a higher high, and a new higher low. So we have a new higher high here, and price breaks through it like this. So now we know that the major trend is bearish. Price moved into premium, and the minor trend has also turned bearish. So this is when we start looking for short opportunities. We patiently wait for price to pull back. Once again, this is where most of us can get confused. Look at this strong bullish move. We have a low, a lower high, a lower low, and a strong bullish move. Now most of us might mark out a zone from somewhere here and expect price to pull back into this and then move up, because we may consider this as a bullish breakout. But we have to keep in mind that the trend or the structure will not change until price breaks above this. This right here is just a minor break of structure. So know the main highs and lows, because these are the highs and lows that can change direction. So we have a new high and a new low, and this bullish breakout is only signaling a pullback into a premium area. And when price reaches a premium area, we rinse and repeat. We go down to a lower time frame and wait for that minor trend to turn bearish once again. And look what happens here. We have a high that created a low. We have a high high, and then we have a break of structure right here. And when price starts pulling back, that is when we draw the Fibonacci and look for an entry. We draw the Fibonacci from this high to this low, enter at around the 61.8 or the 70.2 areas, place our stop loss above that previous high. This will be our target, and this would be the final target. So let's see what happens. And there it is. It taps us in, and then it starts moving down. So this is what happens again and again. It gives a pullback that confuses most of us to go in the opposite direction, but all it does is pull back into a premium price of the previous range, and then it starts moving down. So I hope you now have a better understanding of how to identify pullbacks, how to tell when the trend has actually changed, and where to draw your Fibonacci from. In the next video, we'll talk about liquidity and how it can help us understand where price is likely to move next. I'll see you in the next one.